Back to the phone lines. We have Peter, who's in Ottawa. Good afternoon.
Afternoon, David and Mark. I thank you for taking my call.
You're welcome.
I must remark that this program is my favorite on TV.
Excellent.
Now, my question is on MasterCard. Recently, they announced a split of 10 for 1 and a dividend increase of 88%. Since 2006, that stock has increased 1,600%. Is this sustainable?
Okay, well,
thanks, Peter. Just a minor correction that they raised the dividend 83%, minor detail.
right. Well, Peter, it's a great question. And let me just, I guess, clarify where we sit on these types of things. We believe in focusing on things that are working within secular long-term themes. And when you look at MasterCard and Visa, there is a secular long-term theme away from cash to electronic payments processing. And so this is a theme that is being rolled out around the world and has long, long legs to it. MasterCard is generating wonderful returns for its shareholders. The business continues to get better. They are returning capital to shareholders. We like the financial space, but we really like the card companies. They're almost a technology play. And what I would do is follow it along with a stop loss and benefit so long as we're in a decent market. Generally, the securities that have been leading in a bull market continue to lead. There's been a very strong leadership theme in this sector. So I would run ratcheted stop losses up and behind, which is what we do with our individual positions. Very often what looks expensive is actually not so expensive. It turns out that the analysts' expectations are just too low. And both Visa and MasterCard have been doing a great job. So I like the stock, and I'd be a buyer here. We own it in our portfolios.
Okay, and would you say that another great reason to own them is that there's high barriers to entry to get into this kind of a business?
Very high barriers to entry, very tight leadership between a couple of companies. MasterCard probably, if you look at it, is a little more exposed to Europe. And so to the extent that Europe's recovery is a little bit further behind the U.S., there may be some more legs there.
And just one last question on MasterCard. Would you say that because of the 10 for 1 split, so the stock's going to be around 75.80, it'll bring in a lot of new investors to the stock?
Stock splits are wonderful because very often they do. They bring in new investors. For some reason, they feel that a lower share price makes it more affordable. At the end of the day, a percentage return is a percentage return. But stock splits tend to be a good time to be an investor.
Maybe some retail investors will get in when they were spooked off by a $700 share price.
That's right.
Bruno's in Mississauga. He's got the next one. Go ahead.
Good afternoon. Thank you for taking my call. David, I'd like your opinion on Gilead Science. I wonder if you consider this a buy, and if not, who would you prefer in the same space?
Right.
I'll hang up and listen. Thank you.
Thanks, Bruno.
Bye-bye.
So Gilead, one of the larger biotech companies, biotech has been outperforming pharma. We do like it. This is a $100 billion company. This is not a small startup with multi-products. It's a company that I would buy here. It's just pulled back into the moving averages. It's one certainly that I'd like to own. I think that the other names that we like, Biogen is one, BIIB. But the other way to participate in this sector, maybe with a little bit less business risk, is you can certainly look at the ETFs in the area. BBH is one in particular that I look at and that we hold in one of our funds. We like the biotech sector. There is definitely wind in their sails. And we think there's going to be more consolidation over the next year, so more corporate actions. And I think biotech valuations are going to benefit from that.
Biotechs have had quite a year, as you know, and that ETF, well, I'll let you speak to it, but it seems to make some sense in that instead of trying to pick certain biotechs, you get the whole basket, and something shoots higher than you.
Over time, the risk in biotech is that there have been some spectacular blow-ups along the way. Now, a lot of these companies are becoming more mature, and they have more products that they can rely on other than one or two, and certainly Gilead is one of them. But basket approach is not a bad one. And the nice thing about the basket approach is if there is additional consolidation, you have a higher chance of participating, and valuations probably benefit all of the players in the group.
And you said BBH is the ticker?
BBH is
H is in
one
Harry.
Yeah.
Maybe we can throw that one up in a second here. BBH, Market Vectors Biotech ETF, so there's an idea for our viewers. All right, the next up is Bill, who's in Brampton. Go ahead, sir.
Good afternoon, gentlemen. As always, my best wishes for you and yours.
You as well, thanks.
Thank you. I've noticed it's a general long-term trend, I think, the hollowing out of the middle class, and so a lot of the analysts have been speaking about the high-end retailers, Coach and that are aimed at the high end. But I'm looking at the low end because I see a lot of pressure here, and I was in Dollarama a couple of days ago, and they seem to have some pretty good stuff. There's lots of traffic. The stock seems expensive to me. I'm a value investor, long-term hold, so I don't mind any volatility. But I think this company has real room for growth. They haven't saturated the market in Canada like Tim Hortons. And so I'm interested in your opinions on the company and if you feel that this really is a long-term play given the hollowing out of the middle class.
Right. So, Bill, Dollarama's done remarkably well. And certainly they have their place in the market. In retail, the opportunity always is to build a concept that can then be rolled out across a whole bunch of locations. Certainly Dollarama's business model is that. So when we look at retail, our first place to go right now is the secular theme in web-based retail. So some of the internet retailers we prefer off the top. And then we would look at the high end and the low end. You're right, the middle ground is a tough place to be. So I have no problem with Dollarama at this level. We are not a shareholder currently, though.
And the internet ones you're talking about, eBay, Amazon?
Well, Amazon would be a very large holding for us. The big secular growth theme there. Priceline in the travel space is one that we hold and one that we think looks really, really good. So we look at the statistics, and every year they take more and more market share, and there's more and more operating leverage in the businesses. And they're certainly not cheap, but it's a sector that really is in favor.
When did you get in a Priceline?
We've owned it for a while now. I can't tell you exactly what the price is, but we've owned it several times over the years. And when the consumer starts to spend money, there's all kinds of studies that show the first dollar they think of spending of excess cash is in travel, and Priceline is taking tremendous market share.
Yeah, that's quite a stock. All right, we'll come right back with David Burrows. More questions from you on North American large caps after this.